In this week's Fastest 4 Minutes in Finance, zeroing in on the number one question our clients and prospective clients are asking us about. Hello and thanks for joining us. I'm Scott Inman. Well, I don't have an official number here, but I'm willing to bet that a GenWealth financial advisor is asked about the impact of the U.S. election on the stock market in at least 4 out of every 5 meetings. It's what has investors concerned, and we've had a lot happen. An assassination attempt on a presidential candidate, the sitting president bowing out of the race, and add to that recent market volatility. It's certainly understandable that there is some fear about what happens next. But the fact is, U.S. election years are usually pretty good for the stock market across the board. Take a look at this graphic from First Trust Advisors. This is a list of every election year since 1928, who won, and the total return of the S&P 500 index in that year. The Democrats are in blue and the Republicans are in red. And you can see on the left side of that graphic that if a Republican was elected in one of those years, the average market return is 15.3%. If a Democrat was elected, the return is 8.5%, and the S&P 500 is up on average 11.58% in all election years, regardless of the outcome. And that's pretty close to the average return in all years. So an election year does not automatically mean there's going to be a bad year for stocks. And we also know that we will have a new president since the incumbent is no longer running for re-election. So what about the first year after an election year? Well, this graphic again shows that all the election years on the right since 1928, but shows the S&P 500 return in the year following the election. It also indicates whether the elected president was re-elected or was new. And you can see on the left of the page that the market has performed better when we get a new president, regardless of party. The index is up 12.6% in that new president's first year in office, compared to 7.4% if an incumbent is beginning a second term. Now finally, let's zoom out to an even larger time frame. This chart from Invesco plots every president's full term since 1957 on a grid. The vertical side of the graph is the performance of the S&P 500. The horizontal side is GDP, that's gross domestic product. Generally, this compares market returns to how the economy was doing while these presidents were in office. And you can see there have only been 2 presidents whose entire time in office produced a negative stock market return: Richard Nixon and George W. Bush. You can also see that the economy was not growing at a great pace during their terms. Bottom line is there are a lot of factors that drive the market. Election results will not likely drive it for long. What matters more is what a president actually does to stimulate or harm the economy, and world events that can be completely unrelated to who is in office. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.